What happens with risk parity, it's a concept that was really started by a large hedge fund called Bridgewater out of Connecticut. And risk parity refers to the fact that when you buy a portfolio, the stocks have massively more risk than the bonds. And so if you think about it, let's say you were a 50-50 stock bond portfolio and you're like, okay, I'm diversified, half my money's in stocks, half's in bonds. The reality is because of how much more volatile stocks are, 90% of your risk is probably coming from your stocks. And so the idea of risk parity is that you want to set it so that the amount of risk generated by each asset class is comparable. Here's the challenge, there's a couple things going on, and it may or may not make sense. For one thing, you need to see if it's going to get you the return that you want. So the goal in investing, the number one goal is you need to get your required rate of return. That's the return you need to meet your investment objective. Risk is a secondary characteristic. Risk is bumps along the way, right? Assuming, again, you're not investing all in one thing where, if you invest all in Dogecoin or something like that, you could have a total loss of principal, you can make a ton of money. If you invest in a broad basket of stocks, you're probably not going to have a complete loss of principal. You'll just have volatility on the way. And getting to your destination is more important than the bumps along the way. So you need to get your required rate of return. If you're focusing too much on risk parity, you might be focusing too much on volatility and not enough on return. The other thing is that it can be a crowded trade. Because a lot of funds and a lot of firms have piled into this, what happens is that it's kind of a small door, and they need to, based on calculations, rebalance this in order to maintain parity. And every firm that's doing it has similar calculations of when it needs to rebalance. And so what happens is that when a trade needs to happen, like you need to sell some bonds, buy some stocks in a risk parity strategy or something like that, there's a lot of money moving in one direction or another. And so you can see where these quantitative strategies tend to break down sometimes. So it's something to perhaps consider for a small slice of a portfolio, but it's not necessarily something I would want to do for all my money.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.